Welcome to the Like Totus channel, everybody. Hope you all had an amazing weekend and are feeling energized about the week ahead. Happy Monday to every single one of you, dear viewers. And today's video is on Lululemon's recently announcement of Heidi O'Neill as CEO. We will discuss everything that needs discussing, and hopefully we will be able to make judgments on this CEO announcement by the end of the video. Okay, so I want to share everything that I found with you guys because I was doing a lot of due diligence this morning, and also I've been reading as much as I possibly can, as I normally do, but this time on Lulu, a track record as well. So Heidi, because just to make sure that she, whether or not she would bring value to the company, and this is the main thing that I want to discuss with you, because remember, the four M's include the meaning, then we have the moat, then we have the management and the margin of safety. The management is, by of course, one of the most important things that we can analyze, and a lot of that due diligence is qualitative because you can't really peg certain metrics to the CEO. Other than, for example, capital allocation related ones like Royce or Roy that we've already discussed. But a lot of your due diligence comes down to understanding how much shareholder value have they created at previous companies, if they had been at previous roles, of course, because that is what we want, right? We want to make sure that they have a long track record of delivering value, of creating value both for the employees, but also for the shareholders in customers. Ultimately, that's very important as well, right? So let's talk about what I found, and hopefully you guys will be able to. This will shed light on any of the gaps that there may be that you guys may have found during your own analysis. Okay, right. So Lululemon, let's talk about that. The first thing that I want to show you, as always, I put everything in a Word document. If you guys enjoy, please make sure you smash the like button. It took a long time to put all these relevant data together, and that really helps the channel grow, tortoises. So please spread the word if you think what we're doing here is helping you and other people. Awesome. Lululemon's new CEO, is this a risk or opportunity? I even created a short on this not that long ago, immediately after that announcement, because as you guys know, the stock fell in the aftermath of this announcement, and the stock had already been facing significant selling pressure into this announcement. But after the release, the stock plummeted some 13%, which is staggering. So who the hell is this CEO? Lululemon has recently made headlines with the appointment of Heidi O'Neill as its next CEO, a decision that has sparked both optimism and controversy among investors at a time when the company is already facing operational and brand challenges. Leadership changes matter more than ever. Here's the thing that I want to add. I know several of you are still invested in this company. In fact, you started following the channel. I think the number of subscribers definitely increased every time that I put out videos on Lululemon. So I'm pretty sure that several of you may still be interested in this company, and that is all the company is definitely in our portfolio, in the Like Totus portfolio right now. I want to be full transparent in that regard. And this is one of those times where I always tell you that the only times you need to check in with the companies you own is when they report earnings, and that is the quarterly reports, right, on a quarterly basis, and they also share the annual report that you should read. That said, this is a big event. Every time you see a CEO transition and they issue one of those statements, you have to understand what's happening, because as a business owner, which is exactly how I think you guys to think, that is the approach that I always drill into your heads. You have to consider whether the upcoming CEO has delivered value or not, to make sure that your hard-earned money will be put to work in good use. Will be put to good use. Sorry. That's what we are trying to understand here. And again, as with any investment decision, it's all down to probabilities. Ultimately, As you know, we want to stack the probabilities heavily in our favor. And if we do that across a basket of, if we do that across a basket of 10, 15 companies, we will do very well over time. Right. So at a time when the company is already facing operational and challenge, leadership changes matter more than ever. So yes, this is a time of pause. This is a time when we should pause and should try to uncover as much information on the new CEO as possible. Discuss let's the current situation of Lululemon. This is just to set the tone for the rest of the PDF. For those of you guys who are just joining, who are just new, this will explain to you why what's the reason behind the CEO announcement. Lululemon stock has significant declined, driven by a combination of structural and company-specific issues. Some of the key challenges include North American saturation, growth in its core market is slowing, with demand showing clear signs of fatigue. Rising competition, and by the way, North America, which North American, this the Americas region, as they discuss or like in the reporting. So the Americas region includes both North America and Canada, and both these regions still account for over 70% of the company's overall revenues. So if sales are sluggish there, of course the company will feel it. It will impact the company's growth going forward. Rising competition, new entrants and established brands are intensifying pressure, especially the premium activewear space, the likes of Worry, the likes of Aloe Yoga. Product criticism, concerns around innovation and product appeal have emerged. In fact, it was the lack of innovation that caused sales in North America to slow down substantially because customers got used to what they were selling. They wanted even more. They wanted more innovation, but the company did not deliver on those. Didn't deliver well, they didn't deliver. Let's put it that way. So they didn't. They didn't create the right products, and they didn't create them fast enough. Margin compression, increased discounting, and higher operating expenses are weighing on profitability. In response to that sluggish growth, they lower prices across several of the product line, across several of the items. That has been reversed based on the latest quarterly conference call. They want to place the company back to premium mode. In other words, so it's a premium brand, it shouldn't be discounted, and I think that's the right way to go. They never should have made significant discounts in the first place. Weak North American demand, even after a quarter four earnings beat, underlying demand remained soft. This is the financial outlook. While the company delivered modest growth in an earnings beat in quarter four, the forward picture is more mixed. Analysts expect revenue growth in 2026. However, earnings, which is to say profits, are projected to decline, reflecting ongoing margin pressure. We will talk about margins as well. This suggests that Lulu is currently prioritizing growth and reinvestment over near-term profitability. This makes a lot of sense because if we go right here to the cash flow statement of Lulu, you can see that CapEx has been ramping up. In fact, let's flip this to annual so we can filter out the noise. You can see that CapEx has really moved up sharply. We only see 5 years worth of financial data, but if I go right here to stock unlock and cash flows, you can see that CapEx right here has exploded since 2021. And this is because the company is expanding internationally, which makes sense. And that means opening new stores and building up inventory and so on and forth. So hope that makes sense. And of course, all of that combined with sluggish growth will hurt margins, at least in the short term. Of course, we don't think this will be the case longer term. Otherwise, I would have sold. Anyway, let's continue. Strategic response management is actively trying to reposition the business through product innovation, digital investments, brand activations and marketing, international expansion. This remains a long-term opportunity. The big news, of course, is Heidi O'Neill being appointed as CEO. Lululemon has appointed Heidi O'Neill, a 25 plus year veteran from Nike, as its next CEO effective September 8th. This is what I didn't like immediately after the announcement was made. And if you guys want to hear, if you guys want to go on and read the entire statement that was issued by the company, you can just come here to the SEC filings. So go to Lululemon Investor Relations, and you can see that. Let me have a look. No, this is the. I don't want to do that. I want to come press releases. You could go to press releases, and then you will see that. Where is this thing? Right here. Lululemon names proven brand builder Heidi O'Neill as Chief Executive Officer. Just download the PDF and you can read the entire report. Uh, Right. So let's go back. This is something that I didn't like because I think she should started the role effective immediately. I don't understand why shareholders need to wait until September 8th for her to take the reins. This is something that I don't like because the company is going through a lot, facing difficulties at the moment. She should have started immediately. Her background: she's the former president of consumer product and brand at Nike. She's credited with tripling Nike's women's revenue. And as we all know, ladies and gentlemen, the women category is exactly what Lululemon was founded on, and still represents the biggest share of the lion's share of their revenue. In fact, I downloaded the Lululemon's latest annual report. You can see that net revenues. This is the fiscal year 2025 report. Net revenues come in at 11 billion, but you can see if you go to women category right here, you can see, look at this, 2025 women's apparel represents almost 7 billion. So if you just divide that amount by the total revenues, you can see that the women's segment represents over 60% of the overall revenue. And she, for sure, has a track record of building that segment, which is definitely a positive. She also has deep experience in the exact category Lululemon dominates, women's activewear, of course. On paper, this looks like a highly strategic hire. So why is the market divided? Why has the stock declined 13% after the announcement? Because despite a strong resume, the reaction has been mixed and in some cases critical. So this is the bear case. Critics argue that O'Neill was part of the leadership team during a difficult period at Nike. Look, she definitely oversaw major product development at Nike. So this is a fact. This is not subjective to discussion. We know that she was the product of consumer product and brand at Nike, and we also know that Nike has been struggling as of lately. And part of those struggles include, for example, the wholesale pullback. This was something that Nike did right after COVID. Nike reduced its presence in wholesale channels. Think about Foot Locker that used to sell, and they still sell a lot of their Nike shoes, for example. This created openings for competitions to gain market share. For example, Hoka. Increased promotional activity, something that the current CEO of Nike alluded to. More discounting through direct to consumer channels. He grew tired of all this discounting activity, and in fact, he reversed course, and it makes sense because this damaged the brand perception going forward. Right? Nike is not to be associated as a mediocre company, and so a lot of that promotional activity will dilute brand perception. Not very good. Loss of performance focus, shift away from core performance identity, weaken brand authority in sports, and then we have this legal overhang. And this is something so named in a securities class action lawsuit. My digging led me to this report, to this lawsuit that was that was raised against Nike and ID as well. She's named in this securities class action lawsuit allegations that Nike misled investors regarding its DTC strategy. These concerns, of course, raise questions about whether similar strategic missteps could occur at Lululemon. And if you want to hear more about that, I even I looked this up this way. Is Iri O'Neill named in a securities class action lawsuit, and you can find you can find that lawsuit. In fact, Bloomberg even writes an article about this, which in Bloomberg business, of course, is very credible. And so, if you want to dig more into that lawsuit, you can just come to the Bloomberg business. And you will find more information on that. But there is also the entire report right here, Justia Law. Sorry if I'm mispronouncing this, but you can find that litigation right here. Okay. So I don't like that, but I want to be clear. None of this has been so yes, there is that lawsuit, but it remains to be seen whether Nike and Heidi are going to be accused of anything. Now, what is the bull case, everyone? On the other hand, there are compelling reasons to be optimistic. Why this could work? Category expertise. This is you should take that for granted. I mean, she has over 30 years of experience working in the sector. Of course, she has category expertise. She understands the women's segment deeply. Lululemon's core market, proven growth track record. She tripled Nike's women's revenue, and that is not trivial. This is something that is a plus, not a minus. Brand plus product focus, a background aligns with what Lululemon needs right now: better products, stronger brand positioning, and renewed innovation. What is the bigger picture? Disappointment comes at a critical juncture. The business is under pressure. Growth is slowing in core markets. Margins are declining. The brand needs reinvigoration. This is not just a leadership change. It's a strategic reset moment. There are some risks to watch, as I have right here, namely execution risk. What will she be doing going forward? So I'm going to have to keep a close watch on her, because we want to make sure that she is making decisions thinking long term instead of short term. And another thing that I couldn't find anything. I don't think anything has been shared by the company, but I wanted to see the compensation package. And so if you know anything about the compensation package, I couldn't find anything. So let me know in the comments below, because I would love to make sure that our interests are aligned and that she's going to be compensated on a per share or ROIS basis. Very, very good. Final thoughts. The appointment is neither an obvious win nor a clear mistake. It introduces some risks, but also potential tailwinds. And this is the article, not the article, the document that I put together. So I hope it makes sense, everyone. But also now something that I wanted to share with you is I downloaded an Excel file comparing different competitors in this industry and sector. And I highlight, you can see the green one is Lululemon. The yellow ones are some of the main competitors. They are not necessarily direct competitors. For example, Lululemon industry is the apparel retail. You can see that Deckers is in the footwear and accessories, but Lululemon is actually growing in that segment as well. So even though they are not a direct competitor in the sense that they cannot be compared to a closer competitor like Alo Yoga, for example, but they are definitely there. So let's just, I selected the most prominent ones, and now we can compare them across in the most important metrics. So let's filter this by color. And let's see. Let's compare their margins. And right off the bat, what is incredible about Lululemon, everyone? And this is the power of growth of margins. The biggest test to a company's competitive advantage is gross margin, as Warren Buffett so frequently said. You want to check if the company has a pricing power over time, and that of course comes. You can see that by the evolution of the company's gross margin. Ideally, you want to see growth margin either flat or expanding. That would be ideal, right? Expanding gross margin, even though there's only so much gross margin can expand. But what you don't want to happen is to see it come down consistently. Now, take a look at these numbers. ROIS sits at 30.63% right now. Look at how that ROIS compares to that of Nike, Adidas, The Gap, VF Corp, and all the other ones. With the exception of Deckers, which is not a direct competitor, Lululemon trumps all of them. And the same goes for the return on equity. Look at this. 34 against 22, 16, 23rd. Look at ROIs over the past 5 years, 43. It only declined from 43 to 30. In the case of Nike, from 37, it collapsed down to 14. Same thing with Roy. Look how consistent Roy has been over the last 5 years. While the other ones, like Nike, for example, collapsed from 39 down to 16. Staggering. And then take a look at these margins. Look at these margins. Despite, against the backdrop of tariffs, which definitely hurt the company, they are now trying to adapt. But despite that, even though margins have faced pressure, look where they are. 56% against 57% in the case of Deckers, and 58% right here in the case of Crocs. So they are there. And now look at operating margin, 19.91%, 23 for this one, and 21 for Crocs. And look at the profit margin, 14.22. Crocs profit margin is negative, and Deckers is 19.35. So you can see that from a capital allocation standpoint and profitability standpoint, Lululemon boasts very attractive metrics. Same thing with past growth rates. Take a look at this, everyone. Look at the operating cash flow growth over the last 3 years. It actually accelerated, right? 18.36. It just it doesn't come close to other companies don't really come close to matching these numbers, with the exception of Deckers. In the same thing for earnings per share growth, 24% over the last 5 years. This is staggering. And the revenue growth, all of this stuff right here. And look how little debt the company has. Look at the debt to equity. The debt to EBITDA, 0.54. And then debt to free cash flow, even though the company is using a lot of free cash flows to open new stores, you can see that they can repay all of that debt within less than 2 years of free cash flows, which is so healthy, especially compared to all other ones except Deckers, which comes first. And then this is incredible. And this is what's really staggering. So the valuation multiples for Lulu are much lower compared to those of all other companies. And even though the company boasts much more attractive quality metrics, okay? So I just wanted to bring this to your attention. We are in the face of a company that is much higher quality and trading at a much more significant discount. And last but not least, I want to talk about, in fact, if I go right here, and if we go to the metrics right here, you can see the evolution of the company's margins over time. You can see that they have come down slightly on the back of those tariff headwinds, which definitely impacted their margins. I want to make that clear. And some management missteps, as we've already alluded to, but still, I mean, take a look at the operating margin. The average is 20.94 since 2013. Right now, we are at 19.91. And if you look at net margin, the average is 14.28. We are at 14.22. I mean, what else do you want me to say? In addition, they have a net cash position. If you go to stock and lock and statistics, you will see just that. And so you can see right here, if we go to our intrinsic value calculation model template, you can see I just... on the left-hand side, you have the most important line items across balance sheet, income statement, and cash flow statement. And you can see, for example, all the margins of the company right here, the returns on capital, the valuation ratios right here. I mean, look at the earnings yield. Currently at over 10%, which is staggering. They definitely have a net cash position, as you can see right here. In terms of capital intensity, you can see that CapEx divided by sales sits below our preferred 5%, which is very good. CapEx relative to operational cash flow is higher. Ideally, I want to see this at maximum 20%. We are at 30%, but it makes sense given the fact that the company is doing a lot of investments, and not only that, but profitability has come under pressure as well. And so, yeah, I hope that makes sense. But this is overall, and look at the cash conversion ratio, everybody. Where is the cash conversion ratio? Let me have a look here. I don't find this here. Where is the cash conversion ratio? Right here. Cash conversion ratio over 100%. This tells you the company has quality earnings, right? So high quality earnings. It means that the company is converting a lot of that net income, a lot of those profits into cash flows, which is exactly what you want to see in the business. These companies tend to outperform the average over time. Now, let's look at Phil Town's valuation methods, starting with margin of safety. Analysts are projecting 8 8% growth for the earnings per share over the very long term. I did 10% as a conservative number. I think 8 is too pessimistic based on what the company has managed to deliver in the past. I think they can still I think they can deliver 10% going forward, especially as the international markets expansion starts gaining traction. So current earnings per share is 13.26. If you grow 13.26 at 10% over 10 years, you get an estimated future earnings per share of 28.63. Then for the future PE, you're just gonna do double the growth rate of 10%, which is 20, and that leads to a future earnings per share. That leads to a future stock share price of $572 a share. So this is the future. So in 10 years, assuming our projections are correct, to calculate the intrinsic value, you have to discount that to the present. And we will divide this by 4 because we want to double our money every 4 to 5 years, which is to say we want to get a 15% return on our investments. And in 10 years, you get 2 doubles. So divide this by 4, and this is the intrinsic value, 143. We never pay intrinsic value. So if you divide this by 2, you get a most price of 71. And the current share price is 133. However, once again, the MOS is best suited for companies that are growing faster, not at 8 or 10%. That's why you may be underestimating the company's earning power using this method. So we will pay more attention to both payback time and 10 cap rate. Now the payback time tells us, and if you want to read more, if you want to understand more about each of these methods, go back to our previous videos when I break down each and every single one of you in detail with real world examples. Last 12 months free cash flow, you start with free cash flow. By the way, you can see the disconnect right here between free cash flows and net income. Take a look at this. Net income 1.5 billion. In free cash flows at 921 million. You have to understand why this is happening, and the reason is CapEx. That's it. Okay? Because they should converge over time. Right. So that's why we're going to grow the free cash flows in year 0 at 10% over 8 years, because we think as business owners, we think, okay, so how the payback time tells us how long it would take to recoup all of our investments to recoup all of our investment in free cash flow in 8 years or less or sooner. So the sooner the better, right? And so what this tells you is if you grow your free cash flows at 10% over 8 years, and then you add up all the free cash flows and you divide by the number of outstanding shares, you get the free cash flow 8-year payback time price of 97. In other words, if the company, if you want to get your money out of the business from free cash flows in 8 years, and if the company can go on to increase free cash flows at 10% per year, then you will recoup all of your investment if you pay $97 a share. Right? The stock is currently trading at 133, so our payback time price is actually greater than that, which is not ideal. However, remember that this number is not fully accurate because of because of CapEx. And a lot of that CapEx is growth CapEx that is going to ideally, of course, theoretically, convert into profits in the years ahead. And so to be more accurate, you would have to add the growth CapEx portion of total CapEx to these free cash flows, and that will definitely increase this number. But we will do it like that for the sake of simplicity. And look how close that is to the margin of safety method right here. Now, if you do earnings, of course, the earnings 8-year payback time price is much greater than cash flows because cash flows are lower, again, on the back of the CapEx. So if you want to recoup your investments in 8 years from earnings, then you could pay $166 a share, and the stock right now is at 133, right? And now look at my favorite method, the 10 cap rate owner earnings tells you. Look what it tells you. How do we do that? So we start with operating cash flows, we add total capex, we subtract maintenance capex, the maintenance portion of capex, we subtract that, and then we add the tax provision, and we are left with total owner earnings. As you can see right here, you do that by, so it's operating cash flow minus maintenance capex plus tax provision. That gives you total owner earnings. And if you divide that by the number of outstanding shares, you get the owner earnings per share. And then last but not least, you multiply that by 10 and you get the owner earnings per share. It's like you get, so let me explain this to you because it makes more sense. In real estate, this was adapted from real estate. Investors often accept a 5% cap rate, which means property yields 5% of its purchase price each year before growth. That's why Philtown uses a 10% cap rate instead of 5 because he wants a built-in margin of safety. So a 10% cap rate means the business generates a 10% pre-tax cash yield. In other words, you are earning 10% on your money and would recoup your entire investment in about 10 years, even if the business doesn't grow. And that is why I love this method, because it doesn't include any growth assumptions, right? And you can do that in typical Warren Buffett fashion because he used pre-tax earnings, so EBIT, earnings before tax. And this is very good because it tells you that you can pay $150 for this company, $150 a share, and the stock is currently trading at 133. So at today's prices, you do have a significant margin of safety built in. Remember, every single one of these methods has a 50% margin of safety built in. So according to the 10 cap rate, the intrinsic value is $300 a share, 150 plus 2. And according to the free cash flow 8-year payback time price, the intrinsic value of Lulu is around 200, right? So 97 times 2, that's just about 200. I hope that makes sense, everybody. I would be okay paying 150. In fact, the stock is at 133. I think you already have a significant margin of safety. And so, yeah, this is just from a valuation standpoint. And if you do a DCF analysis, it will be more of the same. So let's say, for example, you expect I'm using, instead of free cash flows, because they are very low, I'm using net income. It's a better, it gives you, it paints a much clearer picture of the company's intrinsic value at this point in time, exactly because of the consistency that it shows relative to free cash flows, as the company is on a spending frenzy, sort of. Look at, this is net income over time, right? And then you can see how that compares to free cash flows over time. You see, much lower because of that, because of the capex. So if you use net income here and you project 8% growth going forward, you can see that the intrinsic value per share is again $144 a share. What I'm trying to do with these models is to come up with an intrinsic value range, and then you try to determine, okay, so what is the margin of safety that you want to have built in? I always want 50%, and so I think I do have that at today's prices. Hope it makes sense, everybody. Let's see what the new CEO will do. I don't have a crystal ball. I'm going to have to keep monitoring every management decision very attentively. But they're undoubted. I mean, she has a proven track record, and I look. I just don't like that she's starting so late. She should start earlier, but it remains to be seen. And now Lululemon is only going to report earnings, as you can see, on the 4th of June. So we are exactly 1 month away from that earnings report. And yeah, so let's see what's going to happen. The outlook right now is quite negative. And it makes sense given all the headwinds the company is living through. But I do believe that they will come out stronger. All right, it's not the first time they face this kind of of headwinds. And I think they will find a way, because companies with strong brand reputation definitely can do that. And based on several metrics, as I showed you, the company does have a moat. You need to have a moat, otherwise those numbers won't show up here. As simple as that. Right, everybody. If you like this video, let me know in the comments below, and let me know also if you learned anything about the compensation package. I would love to, to dig deeper into that report if you find it. So let me know in the comments below. Share the channel, because that really helps us grow. Thank you for everything. See you next time.